Hello, everyone. I see we have two people on the YouTube right now, which is good. I'm here on the Zoom, and there's a little bit of delay, maybe not much of a delay between YouTube. I have chat windows up here on the Zoom if you'd like to introduce yourself. Um, Also a chat window up on the YouTube. If I'm looking back and forth, if it looks like it's a tennis match, it's because the YouTube is over there on my other monitor, and I'm here. We have 90 minutes slotted for this today. Usually I do an hour. But uh, of course, the talk is given my attention span, other people's attention span, the talk is probably just 45 to 50 minutes. So we have some time at the beginning of the end to discuss. As people are filtering in, I see it's just time here in New York, 9:30 a.m. So please, you can put questions in the chat, or if the meeting's open, we can do a discussion. Why don't we slot 9:05 to start the questions? No, start the questions now. Let me just see what accumulates by 9:35, if there is. Make some introductory remarks until then. And then target something like 9:15 to start the actual talk. Meaning, if I remember correctly, that would be in Mumbai. In Delhi, that should be getting to 7:15. Let's see. Yes, 7:15, I think. Good. We have a third YouTube person. That's great. My slides are pretty detailed, so I don't want to, uh, upstage them in the sense of say something that I'm about to say 10 minutes later. But I can tell you a little bit about me. I think I'm happy if you look at the LinkedIn profile as well. I'm from New York City. I've spent some time. My whole education's in the U.S., mainly from Princeton and Berkeley in physics, and then in applied math, financial mathematics from Columbia. I essentially spent, after I got my PhD in Berkeley, I spent 10 years as a postdoc at Harvard in the Center for Astrophysics, which is a beehive, whatever, a center for excellence in astrophysics. And as I described later, I was in X-ray astrophysics, which often has to do with late stage evolution of stars, like the formation of black holes and neutron stars. That was interesting work. It's also, a lot of it is obtaining data, sometimes old data, and working with it and spending a fair amount of time focused on the statistics of the data. So that was a very good training for then moving to Wall Street after 10 years at Harvard. And I've been on Wall Street now for almost 25 years. I'm certainly not the only astronomer or physicist on Wall Street. And everyone thinks that this statement is original, but the joke has been said many times. I can say I went from black holes to black shoals. And just a note that I scheduled this on Sunday after discussions with Pratik Yadav, who is a Pricewaterhouse consultant working in Delhi, but part of oh, I see. Someone just said in and they said that there's a they need a passcode. Okay. I don't know why I need a passcode. Let's see. Maybe he came in. While I look for the passcode, let me just put up the title page of the PowerPoint and share to that. Um, so that way we're all ready to go. Having some technical difficulties here. Let me try resharing. Uh, full screen. And huh, okay, I'm unable to do the slideshow. Let me, all right, first of all, let me get back to, so that the YouTube works. Uh, uh, let's see, just having some issues here. All right, why don't I do this? I'm going to put this in the chat. This is the meeting information. I'm having difficulty with this. Okay. All right. I don't think anything's working today. So I let's see. Stop the share, I guess. Uh try this. Okay, that's that. The Zoom meeting. Okay, and now let's go back to the LinkedIn. All right, we'll start in just a second. I have a colleague who has some problems getting in. I think this should solve this issue, but I'll also put up for everyone. Uh, Okay. Right there. Good. Now let's try sharing again. I think what I'm going to do is maybe the two screens just doesn't work. So let me just try doing everything on one screen here. And back to the meeting. Share my screen. Go to the PowerPoint died.
Jonathan. Hi, sorry.
That's okay. I'm just
Yeah,
getting,
yeah. Then I got this link on LinkedIn. Yeah,
that had an issue. Okay, anyway, you're on now. So let's see.
yeah.
I'm going to do, I'm going to go to the YouTube on my phone. Okay, so sorry, this meeting was supposed to start at 9:30, but we had given some time for discussion. So
Yeah.
let's see what
Okay.
I do here. Let me try connecting up the second monitor.
And
See.
background is quite interesting. Northern Lights.
Yeah, I know. Yeah, I all of my friends got fabulous pictures of them. We're actually fairly far south. We're actually not in the tropics, but we have that's me looking over there because it's the second monitor. I guess there's no way that I can see you. I can hear you anyway. Oh
No,
no,
I'm not. I'm not. I had put my video off for now
that's
because
fine.
of the bandwidth issue.
Right, that's fine. Yeah, let me go back then and put this as the YouTube. Put this over here. Uh, okay. All right. Yeah, there were one or two nights to see the Northern Lights, and some people actually saw it in Manhattan. What they did is they did a long exposure with the iPhone, so it's completely invisible to the naked eye, but then with a longer exposure, they saw it, which is
Okay.
incredible. Usually it's something associated with, Canada or the northern US, like Maine or, the Pacific Northwest, such as Washington or British Columbia. But
Mhm.
for, I guess whatever it is that was keeping it up, put it down. All right, this is going to drive me crazy if I'm looking over there and seeing myself looking the wrong way. Okay, now I'm looking the right way. It's just this is on top of the PowerPoint. I don't know if this is going to survive. You would think after a year or two of COVID that we'd figured out all the issues in Zoom, but we haven't. All right, so it's past 9:40. I said around now I'd be starting. I see two people on YouTube. I see Himo Gandhi here on Zoom, and I'm aware that a number of people time shift this and watch it at a later time. So I'm going to go into the PowerPoint, um, which is issuer credit risk as seen in the title slot here. Let's see what magical key. Okay, so I call these talks MRMD. Um, I like to pronounce them mermaid. I guess it could also be Mr. MD. I started these almost 6 months ago, and the idea is to market um, and, uh, and and foster some discussion because we are doing a model risk textbook. The reference is over here on the lower right, Academic Press. Um, we actually have not submitted the manuscript yet, but the first deadline is coming up on December 1st. So Emal, other people who are probably watching this as playback have helped tremendously with our reviewing the material and optimizing the text. So I encourage any interest in looking at the text from the audience. And also anything we say here today, potentially could go in there. So the idea is, here's a textbook. It's something like 400 pages long in 20 chapters. But the idea of these Zooms is to take one chapter or maybe two chapters if they're related and talking about them for 45 minutes and flesh out some things.
Okay.
Now, how did I? Okay. All right. So just some legal things here. This is a public event. You come in here, it's like wherever you are, if they take a photo of you and they put it on Instagram, well, you're in a public place. There's an interesting little thing, actually. One of our collaborators is an Indian. That's Chandrakant Maheshwari. You may have seen his name in the previous one. And Chandrakant showed me that you can use Zoom to take minutes. So that's called AI Companion. And so minutes are being taken right now.
Yeah.
Mention the YouTube video is going on. I think I'm going to mute you just because until questions for later. I'm going to mute you just so I can focus on this. You can certainly text. And as stated before, there's an archive. The videos can be played back, but it's running on YouTube right now. Looks like a minute or two delayed, but pretty much the same. And then this slide deck, the minutes that I mentioned, and anything else will be posted on a Dropbox site that's public. For example, last week I generated a little toy model in Excel to discuss portfolio risk. So that Excel I also posted there. Let's see. Now we're going. Okay. Did I miss anything? No. Okay. So here we are in the outline, which I posted as a comment on the LinkedIn as well. So essentially 4 or 5 topics. I would say the most important are the different kinds of credit models and the way that agencies and potentially internal people calculate credit ratings. But after that, I will talk a little bit about what the next MRMD is. Spoiler alert, it's going to be part 2 of the portfolio risk talk, and it's going to be on Wednesday in the same time, but I understand the weekday evenings may not work as well as a Sunday evening here for people in Middle East and South Asia. Also about what Delta Vega is. That's essentially my own company. I'm a sole proprietor. And if I can help people also find, consulting jobs or to work for a Big Four firm, I'd be happy to mentor. Right. So the 2 topics in this overview are, what's the difference between issuer risk and counterparty risk? We devote 2 separate chapters to them. We actually tried to write 1 chapter to do both of them, but it just didn't work. There's also a distinction between wholesale and retail borrowers and the way you deal with their credit risk. Essentially, it's large and public versus small and private. All right, so there is a fair amount of terminology having to do with credit risk. But first, let's do the easy, low-hanging fruit. I did MRMD number 17 on counterparty credit risk, or CCR. And that is kind of just in the bilateral context. You have a client, they have let's say just a single swap, and you're worried that they may not be able to make a payment on it. So that's why I say here, the bank is facing a client, a single client. And let's say that instrument is it. That's their entire exposure that the bank has. And just to note that even in the case of an individual swap, you can have, if you like, in the money, out of the money situations. For example, if I pay fixed and receive float, and I'm the bank, and you are the inverse of that, so you're receiving fixed, and I think I said it like that, and paying float, you might miss a payment, or you might not be around, and you might not be around to accept a payment. So it's possible on default, actually, that the bank is making a profit simply because the stream of payments that it had to pay to the counterparty has stopped. And depending on, whether the swap is then in the money, in this case, in terms of relative to par rates. Anyway, and the types of things we discussed for that were CVA and potential future exposure. In this MRMD, we're going to focus on issuers, the ones that issue bonds to the public markets, but they have some risk. They are not U.S. government bonds or UK gilts. These are bonds that are not backed by the full faith and credit of the UK or the US. So therefore, the main thing here is that they can fall in price because of a credit event. I'll be more specific about what I mean by credit events later. But also note that, a bond typically is a fixed rate instrument, so it's going to go up and down as interest rates fall, right? Rates go down, the bond is not as valuable anymore. The bond is valuable. Rates go up, the bond is no longer valuable because you're locked into a certain rate. Okay, so let's take a little bit deeper look into these credit risky securities. It is a wholesale borrower. I'll explain what that means. But in general, there's the credit of the borrower, but there's also the credit of individual securities. And these can differ in a couple of ways. The most important here is what's called seniority, which is, if you can imagine, a queue or a line, and when a company goes bankrupt, there's a long line of its creditors that stand around and trying to get some of the money back. So the senior debt is the person who is the first on line there, and therefore that will have the highest credit rating. Later we'll see that that's called AAA, usually. And then you sort of go down from there. Sub-senior gets what's left over after the first claim, after the senior is exhausted, junior debt, and so on. And then for completeness, I'm including things that are not common stock. Preferred stock is maybe 80% can be thought of as a stock, but 20% as a more senior security, just because it does have a higher claim to bankruptcy. Also note that these different securities can be issued by different legal entities, different corporations. Like some of Ford's bonds are specifically by its subsidiary, Ford Motor Credit. So if you are receiving interest payments or principal and interest from a Ford Motor Credit bond, and Ford Motor Credit goes out of business or has an ability to pay, that's a problem. But the parent company, Ford, may still be around. And finally, as we discussed a little bit in a previous talk about the difference between the new risk-free rates and LIBOR, some risk-free rates are collateralized, like a car loan or a mortgage. And so therefore, that makes them more senior, or rather, it makes them less risky. Okay, another distinction is the disjointness of bonds. That is, they're in two sets, but the two sets are mutually exclusive. The first one is high-grade bonds, which I discussed quite a bit in MRMD number 20. They're certainly higher in credit quality. Generally, they're quoted as a spread to a government bond. Like here in the US, it's common to quote the 5-year Ford bond as a spread to the 5-year US Treasury rate. Right. And when things are quoted to spreads like that, they're essentially nearly risk-free. The Treasury is, as we said, nearly risk-free. And so when their credit is impaired, their spreads relative to the Treasury widen. Conversely, when their credit gets better, those spreads can narrow. But you're basically you're trading spreads. On the other hand, high yield bonds are poorer credit, and they're in the world where there really is risk. So in fact, bond prices are generally described by par 100, so essentially a percentage of par. Um, and in this case, like if a high yield bond is trading at 75, that's pretty much saying there's only a 75% probability it's going to survive for the next year. And just to remind you that not every bond is a bullet bond. A bullet bond is basically, a series of periodic interest payments. Let's say in the US, it's common every 6 months. In Europe, I think it's a year. And then a premium repayment at the end. But you can have more complexity. You can have embedded calls and puts, as described last week. You can have a sinking fund schedule, which is an AMSCAD, an amortizing schedule. That's like a mortgage, and some bondholders require those or prefer those because that means, as in a home mortgage, that every period you are receiving not just interest but premium. So that like the conclusion to an FX swap is risky because an amount of currency has to be exchanged and it's a big lump sum. So if you can split those final payments up and shift them into periodic payments of principal, then you may be in better shape. All right, so I did promise to define the difference between the two, wholesale versus retail borrowers. Banks in the issuer context deal primarily with wholesale borrowers. So, for example, an issuer of corporate bonds could be a bank. It could be, as mentioned, Ford or another company. So, it files its balance sheet and income statements with the SEC. A variant of that is a large private company, like I know Deloitte, for instance, the Big Four consulting firm, is a private company. But because of the Dodd-Frank Act, they're audited by the Private Company Accounting Board, the PCAOB. And in either case, analysts can report on the condition of the issuer, like you can see in Bloomberg. And, so there's a fair amount of public information. There is not the information asymmetry that there might be with a retail borrower. A retail borrower is, anyone else. So that could just be someone who has loans, for instance, loans outstanding that complicate its credit picture. So then it owes money just as a large issue would owe money in periodic interest and principal payments. In this case, there's little public information. You can't find it on Bloomberg, even if it's, and it may not be audited because I guess it may be too small below a de minimis level to be audited. In this case, the focus is probably more on counterparty credit risk, so deal by deal or as a netting set. And I'll explain, I'll refer anyway later to netting sets, but that means that all the client's positions with you are netted together so that the exposure, can be, the net exposure is really what you're responding to, that each of these individual positions can all be canceled out and save some money essentially for the client in terms of posting collateral, margin, and so on. But in the second one, the bank is facing the counterparty directly, whereas in the first one, it is to an extent, but that the obligations that it has are to other entities, to third parties, to make payments of interest. All right. Now, I see we got 4 people on the YouTube now. That's excellent. And as I said, greetings to all of you who are going to be watching this in the future on YouTube. And all of our MRMD talks are archived on YouTube, the ones that I'm referring to here. So I think Oxford English Dictionary would give you that a default is just missing a payment on an obligation. There's a contract, so if you don't pay your babysitter on time or your cleaning lady, technically you're in default. But it's all a question of degree, right? If you are one day late on your mortgage, a bank is not going to put you in a default bucket. If you're 30 days late, which means you clearly missed the time that a payment was due by a large amount, then that's troubling. 60, a bit more. I believe at 90 is when the bank starts to think about that they may need to foreclose you. But perhaps earlier when there's a credit crisis, like in the great financial crisis. But this is complicated, right? This is sort of a binomial. You either miss the payment or you don't. So that's essentially even simpler than that. That's a Bernoulli trial. You might be able to make a partial payment, but there really is no standardized definition that I can give you here of what is quote unquote default. I'll talk later about credit events, and they're clearly described, especially for the case of credit default swaps. And here they are. So credit default swaps, which I'm going to explain later, are a way to hedge or speculate on a company's credit. So here, generally CDSs, I refer to a Princeton paper here. That's what's in the footnote. But, a company going bankrupt, which in the US could mean restructuring. The third one, so the top one here, then bankruptcy, is the Chapter 7, which means the company's dissolved. Can't pay anything. And then the people start waiting online to collect. Or a failure to pay, as I said, and here you can see it's a bit qualitative. It says after a certain grace period. So that would mean, for instance, the 90-day period or 60-day period, let's say, for a monthly mortgage. All right. So the three universal metrics of default are PD, probability of default, LGD, loss given default, and EAD, exposure at default. In MRMD number 17, which was the counterparty credit risk discussion, I posted the standard definition of CVA, which is credit valuation adjustment. And this is essentially the price of default. I'm not going to go through how you calculate CVA here, but I will point out that the three quantities I mentioned as being canonical are all under or within the integrand here, and one is in the differential. So, for example, so let me just read that. Between CVA is between 0 and a capital time and a time t equals capital T. The expected value under the risk neutral measure of this quantity in brackets is integrated over the probability of default as the differential. Within the expectation in the risk neutral world are three factors. The first is the loss given default. The second is a discount factor, like B0 is a zero coupon bond, say. And the third is the exposure at default, or rather just the exposure at a given time. The vertical line is telling you that this is evaluated at time t equals tau, which is the hypothetical time that this credit event has occurred. So I think I've said most of that. The main thing is that the probability is the probability of default between 0 and a time t. And the simplification is that if everything is independent under the integrand, well, you still have to take expectation, which is yet another integral. But, it's something like the product of these three quantities, LGD times EAD times PD, is the charge for the possible default. So I said this, I think, already. Just to notice on the first point that PFE uses the historical measure, as does most of risk management. It doesn't use the risk neutral measure. Indeed, credit ratings also use the historical measure. So from a real analysis standpoint, you can ask yourself, well, if they're just looking at the past history, ... maybe it's not that accurate. within issuer credit risk, we could use the CDS market, which is risk neutral and pricing, or we could use bonds. People tend to mix, unfortunately. And then just to say, PD depends on which type of credit event, as described earlier. LGD is not generally observable, but needs to be assumed. And EAD, I'll describe two approaches. This got cut off, but let's see, is that on the next slide? But essentially, one is for larger banks and an advanced approach, and the other is kind of a rules-based approach to calculate EAD. All right, so let's take LGD first, and we're going to talk about something called recovery. So here's a little photo here of recovery, meaning like what, let's say, a Bollywood or an American rock star goes to a retreat because they need to recover from fentanyl addiction or something like this. So that's a little joke. Anyway, essentially, you don't know how much is recovered until there's an auction of the bankrupt entity and the amounts are actually paid out. For convenience, we're going to talk about recovery here as the complement, the complement of loss given default. And usually recovery is greater than zero. You don't lose more than the bank itself. You could have some cases where you lose everything. Now, the hard-coded assumption often is that 40% is the recovery of a bond and 60% for a loan being more secured and generally being collateralized. But, there's a sensitivity to small changes in recovery in the same way that delta or DV01 are marginal changes. So I think it's pretty important. I've had this discussion with a lot of people in the front office that you need to know your marginal sensitivity. If you're off in the recovery by a basis point, what does that actually mean to, the price of your instrument? You would think that it's an increasing function of recovery, that the higher the recovery, essentially the more you will recover, so the lower the credit risk. As far as the idea in practice, and here's a little joke about practicing. Let me take a sip of water. So, a regulator like Basel has two possible approaches: the foundation approach and the advanced approach. So in the foundation approach, you just look at a client as one unit, and you model the forward value of their investment, of their exposure, of the holdings that they have that you face them with, and also the ones that they're issuing to the public. It does not include collateral, and it does not include netting. And here I said I left out a fuller discussion, but the plus sign here, the reference, is a good PowerPoint by the New York Fed about netting. There are 4 different kinds. I believe closeout netting is the one that's the most common. But it makes a big difference that the credit risk of an entity is not just the linear sum of its quantities, because there's some cancellation, right? It could be long here and short here, and therefore the credit is important to look for in a netted sense. In the advanced approach, netting is included, and so is collateral. And that can be done for each client position and then summed up or netted off as necessary. So it's more accurate. But it also takes time. It takes hiring quants like us. And so therefore, not every bank is doing it. I want to go now into the quantitative aspects of these canonical 3 credit issuer credit risk metrics. So just to preview, I will discuss 4 different kinds of probability of default models And generally, of the three quantities, PD, LGD, and EAD, the PD is the one that has had the most focus and the most variety. So the first two are thinking about two different things. In the first one, and there's a detailed model I'll go through, a company has a certain structure on its balance sheet and its income statement. So these are called structural models. So the idea is that if the value of its assets fall below the value of the debts, what it owes, then in a log normal sense, it will default. The value corporate assets minus debts is always greater than or equal to zero because the company has limited liability. That's why it's a corporation to begin with. A company cannot have a negative stock price. The second type of model are hazard models, which don't use any of the structure in the balance sheet and the income statement, but rather they simply model it as a Poisson process. I'll refer to this later, but we discussed Poisson, negative binomial, zero inflated Poisson, and so on, different event models in the context of operational risk in an MRMD. This also starts to go into my field of X-ray astronomy, and there'll be a little slide on that. And as I said, one of India's greatest physicists was someone who worked on X-ray astrophysics, the late Chandra, but I'll talk about him later. A third kind of model that's used is a scorecard model. So in that case, you can look at the structure and you can sort of back out something like a principal components or identify the key eigenvectors that describe this company's credit risk. So those eigenvectors are the factors and the eigenvalues are the loads on those individual factors. And you hope that there's just a few in the sense of size of eigenvalue factors that can describe everything. And then finally, we'll talk about logistic regression, where the challenge here is that the predictor variable needs to have a range that's 0 to 1, because this is a probability, where I think, as you know, in ordinary least squares linear regression, the range of the predictor is minus infinity to infinity. So a transformation needs to be done. So here then are the details of the models, the probability of default models. So to reemphasize what I said a minute ago, the structural model is going to be something where the company almost decides to default. There's a kind of optionality. But along the way, there is a kind of moneyness idea that's called distance to default. So that is, how far are you from the point where you might want to exercise the option to default? Again, some more detail coming. The reduced form models, those are the Poissonian ones, have a lambda, just like any Poisson process. And here's a reference to the relative MRMD that talked about those. It's essentially a one-parameter jump model. And lambda can be estimated by credit default swaps most commonly. In the scorecard model, as I said, we're looking at factor loadings, and then we'll take a weighted average of those. The weights we use may be based on quantitative, or they may be based on expert judgment. And finally, logistics, which is a calculation of odds, as opposed to, let's say, the slope in a linear regression model tells you something about of a particular projected onto a particular predictor variable, tells you how important a marginal change in that variable is. So in this case, the logistic case, it's the odds of the default happening, or the ratio of the default happening to the default not happening, like 5 to 1 or 100 to 1 or something like that, as you would in gambling at Las Vegas. I don't know if in the other parts of the world, like India, that are listening, but here now in American sports, before they start a game, first they tell you, like, we're in the baseball season playoffs right now. So first they'll tell you about the players and their skills, and then they'll take 5 or 10 minutes now on national television to tell you what the odds are, the over under, all stuff like this, that gambling is now legal and it's a huge business. All right. So the structural models are essentially all based on something to do with Bob Merton. So here's a short digression of Bob Merton, a brilliant quant, still alive, who was born in New York City. And as actually his father was a very important contributor to the idea of sociology and a longtime professor for 5 decades at Columbia here in New York City. He meaning Bob Merton, had an illustrious career and ended up writing a dissertation with Paul Samuelson at MIT. He then was offered a position on the MIT faculty and was there at the same time as Fisher Black and Myron Scholes. His chief contribution to what's called the Black-Scholes model is the ability to do things with stochastic calculus, that is, in continuous time. So I personally call the equation the Black-Scholes-Merton equation. It takes the discrete context that Black and Scholes had come up with and makes it something so that you can do differential and integral calculus. So you can calculate things like delta and vega, and so that you can, the integral then is, the value of a portfolio of stochastic assets over time. For this work, Merton shared the Nobel Prize with Scholes in 1995. Fisher Black unfortunately died 2 years before that prize, and the Nobel rules are that you can't get it unless you're still alive. Now, we definitely need to talk about long-term capital management because even just a year after winning the Nobel Prize, he and Scholes, who shared the prize, almost destroyed the world economy and made a, depending on how you like it, I would say $1 trillion mistake. They made some bets. I'll talk about that below. But in order to get them out of the debt and not bankrupt the world economy, the US had to pay almost $4 billion to this fund to bail it out. So why is that? I said trillion and I said billion. Well, the world GDP in 1998 was about, 30 trillion. I'm just using this scientific or exponential notation just because it's easier to work with that here. So I hope you're comfortable with that. But, of course, E9 would be, E9 would be billions. So 10 to the 9th. So E12 is trillion. So one of my co-authors, Martin Goldberg, says, essentially, you can think about this as a very strange loss distribution, in which case almost 99% of the time, LTCM was expecting, or its PDF was, a loss of zero almost 99% of the time. The problem is that a very small amount of the time you lose $1 trillion. So, and it's not that small of a time, 0.116%. Is, that's not 1/10,000. That's not 1 to 1,000,000 odds. That's less than 1 in 1,000. We have 500 in 1,000. But anyway, if you do that, then the expected value of, of world GDP is that you lose $3.6 billion. That's why in this inset over here on the right, it talks about that they were betting $1 trillion. Right. So don't do that. Now, let's go into the meat of the Merton 1974 model. Here's the reference. The two important quantities are the assets, which is capital V sub T as a function of time, and the corporate debt value, K. And I use that format because Merton modeled this as a European option. Sorry, it's an American option because it can be done when it wants to be. But E, which is essentially a measure of the credit quality here, and PD is a call option on the underlying V struck at K, right? So the standard convex formula for the maximum. As long as E is greater than 0, then the company is not in default. But if E is less than 0, then let's see, I guess in this formula, it can never go less than 0. But when it goes to 0, it's in default. Okay, so this is wrong. It says if E should say if E equals 0, the company is in default. So E in that sense is a measure of what I call distance to default, in the sense that the higher it is, the lower the probability of default, and it's monotonic that way. So in this way, if I calculate the delta of this option, that's something like the risk neutral probability that it will not be a bankrupt at maturity at time t. Now, the problem then is therefore, how do you compute V, T, and K? Traditionally, if it's a wholesale company, then it's public, and then you can look up things like it's tier 1 capital. Here's a reference to a discussion of that. But essentially, for the moment, let's just think about that as cash plus the number of stock shares that it has outstanding times the price of the stock today. All right. In general, there's some tier 2 effects as well, like preferred stock. But let's say that it's, for the moment, it's dominated by just the common stock. And then we can snapshot the debt from looking at the last quarterly report filed with the SEC. These are called 10Qs, Q for quarterly, or 10K for the annual. And then this first bullet here, the issued bonds plus the borrowed funds in the loans is primarily what its debt is. In general, the more detailed, the better. As mentioned before, there are issues of seniority, of secured versus unsecured, of which legal entity is issuing them, and of embedded options. So the problem then becomes that this cannot be done for the more retail credit cases. You might have retail conversations with a retailer that are private, but those are unaudited, and you might have very little information, so you're going to proxy it with respect to a public company that you do know something about. But anyway, for the purposes of this slide, let's say that it is possible to compute V, T, and K, and to do that anytime that you want to. So what's the solution for E? Well, here it's basically just a European call, right? So here are the closed form formulas. These should be familiar to, I think, anyone on this call, R being the risk-free rate. The one thing that needs to be imputed or estimated is the implied vol of this option. But of course, that can't be seen. You can't really know how volatile a company is in the sense of its credit. Traditionally, the volatility of the company's stock price is used. So this assumes that the issuer is the same legal entity that's trading as a stock. So for that Ford Motor Credit case, there is no stock. But if it were the Ford parent company, then there would be a stock. Regardless, this is now getting us back to historical paradox, that we're not using the risk-neutral pricing measure, and yet we're using risk-neutral pricing. So my favorite example of this is, why did the Titanic not have enough lifeboats? And that's because it was just using past experience. It was using the historical measure. There had never been a Titanic that hit the iceberg, that hit an iceberg and sunk. So therefore, they had enough lifeboats for the worst thing that they'd seen leading up to that, like a look-back option. Now, this is the basis of many of the rating agency models, this kind of Merton, KMV, 3 authors. For example, that's in Moody's bought KMV, and that's the one that they use heavily. But as you've seen, there really isn't a probability of default calculation. The it's more this distance to default. There's no guarantee that that's a probability or how to relate it to a probability in the sense of something with a probability measure whose range is between 0 and 1. Yeah, there may be some attempt to calculate LGD here, helped by looking at its detailed assets and debts. However, I'm sorry, I'm reading my own notes here. It doesn't provide a way to get LGD. It also doesn't take into account correlated defaults in the sense that you're just modeling one firm. If Ford and General Motors are both seeing tough times in the markets or supply chain problems or whatever, then their defaults may be correlated. And we all know the great financial crisis had a lot of correlated default. There also isn't a measure of the business cycle, that is, of the periodic up and downturns of the of business cycles of an economy, a microeconomy, in the sense that it's something like supposedly mean reverting to a long-term stable value, but may not be there right now. And finally, this model doesn't really take into account what the bank itself might think about the issuer credit, which may be specific in the idiosyncratic sense of the capital asset pricing model. It's also a little bit ironic that the Dodd-Frank Act has a title, meaning a chapter, where the purpose is to eliminate these rating agencies because it was perceived that, S&P, Moody's, and the rest of them were somehow incestuous or somehow too close to the companies that they were rating. The bank maybe have pushed them to give a better rating than actually was consistent with their financials. So then moving on to the second type of model, which is sometimes called reduced form model. That's because in this case, we're completely outside the structure of the company. We're basically just thinking about credit events in the Poissonian sense. Another drink of water. Because we're going to use primarily credit default swap data, now we actually are in the pricing measure. So we do have a predictive sense here. We know what the price of their credit default is today. So then this is probably more likely to be accurate for the future. Right. And so just as with bonds, the larger the spread of a CDS, the larger the probability of default. Now, let me just take a one-page detour from this, because I used to do astrophysics. We launched the Chandra X-ray telescope in 1999 on the Space Shuttle Columbia, and I worked on part of that. It's still active. It actually was only supposed to survive for 5 years, but of course, it's now been up there for 25 years. It's been up there for my entire time that I've been in my second career on Wall Street. What I like about it is that it's named after a great physicist. I'm going to pronounce this wrong, but let me try. Subramanian Chandrasekhar, the great, I would say, one of the world's greatest physicists, certainly one of India's greatest physicists, was born in Lahore, but then did a PhD in the UK in Cambridge, and then spent his career at the University of Chicago. So just a little bit as kind of a sidetrack here about Chandra and how dedicated he was to teaching. So he's in the Department of Astrophysics. It has a telescope, but you really can't put a telescope in the city of Chicago, just like New York, or I guess India's and the Middle East large cities. There's too much light. The Chicago is on Lake Michigan. There's also fog and haze. So they got some property up in Wisconsin. Wisconsin is the next state north from Chicago. Chicago's in Illinois, and Wisconsin goes north all the way to Canada. So this, it's a small town, Williams Bay, and about 160 kilometers north of the university. So that ends up taking you about 2 hours drive each direction. Why is that location important? Well, most of the courses traditionally, let's say in the 20s, 30s, and early 40s in astronomy were taught at Yerkes up in Wisconsin. So students would need to take courses there. However, in 1948, the University of Chicago decided to offer classes at its city campus, which is on the south side of Chicago. So that in that first year, there were only two graduate students who signed up for Chandra's class. He could have canceled this. He could have asked them to come up to Yerkes, I guess, any number of things. But he decided, you know what? These students seem to be very dedicated. So I'll be dedicated myself as an educator. So I guess probably at least twice a week, he would have to drive 2 hours each way to Chicago from center of Wisconsin to teach them. Was that a good idea? Well, it's nice to say it this way. In 1957, not even 10 years later, that class, those two students, shared the Nobel Prize in physics. Their names were T.D. Lee and C.N. Yang, both born in China, but doing most of their work in the U.S. T.D. Lee was a longtime Columbia professor here in New York City. And just to say what they discovered it for, it's essentially that in the macroscopic world, you look in the mirror and things look the same. There may be left-right exchange, but it's the same physics. Whereas with small particles, there is no reflection symmetry, so that's called the parity violation. This is a very beautiful experiment as far as modern physics. All right, so that was the detour into physics. Now let's talk about credit default swaps, because they are the way that we estimated probability of defaults in a hazard rate model. Right, so here's a canonical description, ideal case of a credit default swap. It's essentially a credit derivative that provides insurance against a credit event. Specifically, it is a swap. It is a bilateral transaction. Party A purchases insurance. Party B sells A insurance. And what is the insurance against? It's against a credit event occurring within a period between now and capital T. So party A may be motivated, for instance, because it may hold some bonds issued by C, and it may be concerned about losing. How much would it lose? Well, it would lose the loss given default times the exposure that it has to C. Party B is motivated because they would like a cash flow. They're like an insurance company. They're like an insurance company for the big hurricanes in Florida right now. They bet that they can charge a high enough protection payment or insurance premium that they can collect, and that the probability that the policy will need to be implemented, will need to make payments, is low. So as this goes along, B, often it's quarterly payments. A will pay periodic premiums to P, perhaps quarterly. B receives them, banks them. But there are two things that are outside the ideal case here. First of all, we're assuming that A will, for the purposes of this deal until capital T, be able to make payments, be able to make premiums, and that party B at the conclusion of the deal will be able to pay LGD times EAD. It also assumes that neither A nor B nor C are correlated. So therefore, any increase in the credit impairment of A has nothing to do with a credit event with B. And similarly, for B, for its paying to A, it is supposed to be independent of C. Of course, the big reason for the financial crisis is the second one, that the parties that were providing protection then were correlated with the party that they were providing the protection for. B is correlated in C in most cases, and that's a problem. Anyway, there are two things that could happen. First of all, there could be no event by capital T, and then the swap matures. A no longer is paying insurance, and B has now made the profit of collecting that insurance, those premiums. On the other hand, if there is an event before T, then A stops paying premiums, and B then needs to pay the amount that A has lost in that default because of that event. So I've alluded already to some of these things, but the red things here are the bad things. So B may not get all the premiums, and A may not get all of or any of this recovery payment, LGD times EAD. Yeah, I work out the mechanics here in the correlation and credit impairments, but essentially this is a little bit like wrong way risk. I refer that in a later slide, that the credit plus correlation is a dangerous combination, essentially. And if you're AIG, the large American insurers, then you bank all these CDS deals, and all of a sudden, you are in wrong way risk in a very huge way, and you're on the precipice of bankruptcy. What is the mechanics for calculating the PD? Well, as I said, you can think about this. Some of you may have background in physics and engineering. So just like the Chandra X-ray satellite, we're detecting the individual events, photons from a star hitting the detector. So here the individual events are the credit events, or things that happen to a company. And to a close approximation, the strength of that, the lambda in the Poisson model, is related to the observed spread of the CDS and the loss given default. That's the first equation here. Recall in the Poisson context that in any given time interval, a small interval between T and T plus H, the amount of loss is lambda times the size of that interval. This is the waiting for a bus or waiting for a train problem, that it's a random process, but the longer that you wait, the more likely the next train or bus will come. And so then it's relatively easy to develop this expression where you can calculate the PD having known these market values. And just for fun, poisson means French, means fish in French. So here's a fish, not the kind of fish that you would see, let's say, in the Ganges or in the Hudson River or the Thames, but this fish, this Poisson process, can be potentially as scary as a shark. Scorecards we referred to a little bit before. They avoid having to do either the balance sheet and income street analysis, and they help when there are no CDS spreads. But essentially, they're just large linear models. The weights of the factors are then calculated, and then you can do a sum product of those. So that gives you a score. And depending on how you calculate this, probably you're calculating the strength of its credit position. So then the PD would be a decreasing function of that. There is a case where the weights may not have been normalized, so then just divide that sum product by the sum of the weights. Okay, but again, just like in the case of the structural models, this is not a true probability. You have to fashion the score so that it does end up on 0, 1. And in fact, this may be more of kind of an odds measure, which I'll talk about in a minute. This is that the higher scores here may be the less likely to default. So they may be the ones with higher credit quality. And in some sense, the exact credit rating is less important than the relative rank of that credit rating, which is kind of like an order statistic or a percentile risk, as we discussed in a previous MRMD on market risk metrics. Now, indeed, one does not measure these credit events as a regular basis. So most of what one observes is a company going toward a credit event. And so that at any given point, it will have a number which is in the open interval between 0 and 1, not the closed one. Logistic regression enables to capture that intermediate type of PD. And as with most regression, to do that from a small number of predictive variables, right? So like inflation, unemployment, or things specific to the company. Now, linear regression, of course, the response function is on the real line, but these are probabilities. So you'll need a transformation of some kind, which I'll describe on the next page, of how to transform the interval minus infinity to the interval 0 to 1. But basically what we're doing here, as I described, I think I already said this. So yeah, instead of like a slope and an intercept, you're describing the ranking of the probability of something, a credit event, to the complement of that, the lack of a credit event. And so we can answer the question if we have a calculation of ExxonMobil being, I think, the world's largest oil company, right? If the price of world oil falls by a certain amount, like $50 a gallon, then how much does that increase the risk of default for Exxon? The transformation is what's called, this is one of two common ones. The logit is the most common. And this transformation for any real number P will put it into the interval 0, 1. But what's more interesting than that is that this is the log of a ratio of two things that can be intuitively understood. One of them is the probability of default, and the other is the probability of not default, or of survival. And that's what an odds ratio is. I think there was a comment, but let me talk for maybe another 10 or 15, and I'll leave time for some questions at the end, or put them in the chat, please. So just to say that we can do the type of fit diagnostics like p-values on the coefficients. We can do, this is maximum likelihood, so we can do deviance. And we can do what's called a half normal plot, which is like the QQ plot. You may know, compare the CDF to that predicted, for example, like a normal distribution CDF. It's called a half normal plot because, again, it's a restricted interval. There are no negative probabilities. And we do some examples of those in the context of the textbook for credit ratings, and just for logistic regression is also heavily used in machine learning. And we covered that as a past talk in the series as well. So then now we can finally talk about credit ratings, and this is essentially the last of the main sections of the talk. First, a little bit of history here, that it was, you may appreciate this if you're logging in from a country like India or Abu Dhabi, or watching this, that credit ratings first occurred during the industrial age of the United States, because the railroads needed to be built, especially the ones, I think folks know a little bit about US geography. It was critical to have a railroad which could connect the two coasts, which back then would mean connecting New York to San Francisco. And so the companies that did that issued corporate bonds. And so then investors wanted to participate in those bonds, but were guided by ratings. Now, the credit default swap market is a 20th century phenomenon, so almost 100 years later. Just to say about the ratings, they're typically revised annually, and they are essentially a PD of what will happen to the company in the next year. The language here is, or the notation is, that AAA is the highest, then AA, and so on. So it's like, grades in school, A+, B, C, and so on. Also a distinction here between high grade and high yield. I mentioned this before, that there are differences in where they're priced, like high grade is priced to spread, high yield to price itself. So you should know that, there's a discontinuity, or there's a jump that happens if a company that's been sitting at BBB, just in the high grade, but at the bottom of the high grade category, and then is downgraded to BB. So then that creates a lot of dumping of mutual fund managers, who generally are either high grade or high yield. All the high grade managers then have to find another high grade name to replace that one. And there's a lot of maybe not panic selling, but certainly selling. Also to note that the ratings themselves are not necessarily static, but may incorporate a forward understanding so that these are sometimes called the watch list, that Standards and Poor's or Moody's may say, well, it's AA with a positive watch. So it's expected to be upgraded to AAA. And the converse is for a downgrade. As stated before, the agencies use structural models like Merton. Now, abstractly, one might think about three different ratings types and how the ratings relate to PD. So the easiest one to understand is probably a point-in-time rating, where the ratings are always mapped to the same PDs. So let's say the least probability default bucket, we bucket them, let's say, because we're talking about matching a discrete scale. So, just like the calculation of grade point average in the US will tell you whether you have an A or an A plus. And then these are sticky in the sense that they always are like that. The lowest will always be D, and here it will always be 0.9 to, that should be, of course, 0.9 to 1.0. In a downturn, what happens is the corporation then has a higher probability of default and then transitions to a lower rating in this point-in-time scale. A through the cycle rating is not sticky in the sense that the rating is fixed, but the PD is not. So therefore, the mapping for example, AA might be the second category of 10% to 20% percentile in a calm market, but in a in a tough market, in maybe something like a financial crisis, then AAA would be the second bucket, 20% to 30%. Now, of course, the rating agencies don't use either of those, but this just sort of gets you thinking along the lines of what's important. The agencies use something which is I would call the worst case rating, which is essentially, it has relations to this point in time and through the cycle rating, but it actually reflects the amount of time that the company can survive. So, stochastic calculus, you may be familiar with the term stopping time. This is essentially the longer the stopping time in the future, then the more the company will survive. So, for example, in a rating scale, the ability of a company to survive the Great Depression in the United States in the next year would give you a AAA rating. At the opposite sense, if a company can only barely survive an average year, then it's a BBB rating and so on. Now, banks can also develop their own internal credit ratings. As stated before, the sense of Dodd-Frank, the 2010 United States Act signed by Obama, is that we should get away from Standard & Poor's and the other national statistical rating or NSROs, and we instead should have the banks rate their issues by themselves. After all, they're the ones that know in detail about the exposure to their clients, and they also could then use that to extrapolate to taking on a new clients. So of course you try to use some issuer financial. I mean, I'll tell you just what these look like is they look like massive spreadsheets trying to incorporate different issuer financials. So some of them may not even be models, they're more tools. And again, that's a debate that we had in a previous discussion. Yeah, I think I'm just looking at the time, I think most of this I've said, but it's hard to build a challenge model internally. It's hard to do effective challenge on an internal credit ratings model. You cannot benchmark it to S&P ratings in general because those probabilities, as we said, are moving around. One advantage, though, is that you could update this more frequently. You could do it quarterly when you get the 10 Qs, whereas the agencies are basically just changing their ratings on an annual basis. So that may not be as sensitive enough in time as for a bank facing an issuer. Now, I mentioned correlation here and there. Here I connect again with the types of wrong way risks. And also just to mention that ratings don't take into account like contagion. So one example of contagion in the great financial crisis was that it was thought that if you had a real estate portfolio that contained essentially every metro area in the United States, then there was diversification. That it would never happen that every subprime loan in the country would all go bad at the same time. But of course they did, and as discussed in previous talks, in a crisis, correlations can approach one, so everything is correlated. So then there was no hedge by diversification. And we've already talked about stresses like supply chain. All right, so therefore, to sum up, issuer credit risk is quantifiable to some extent. It differs from the prior talk on counterparty credit risk, is that the issuer is not just an end user and is capable of issuing debt in various complexity. And also that the CDS tells a different story than its bonds. Some of you may know that there's a way to calculate essentially the spread, what's called the swaps, to calculate an asset swap, and that there's a basis between the credit that's determined in the CDS and between the bond. Now, of course, again, bonds are the historical measure and CDS is the risk neutral measure. So we would not expect the spreads to be the same, but that can be a traded basis. And finally, that the ratings are this piecewise continuous representation of issuer credit. It's, if you like, it's a step function or a function with steps. Like, let's say the tax system in the US is defined by brackets by the Internal Revenue Service. So if you make this amount, then you pay this tax. Otherwise, if you make a little bit more, then you pay this entire amount plus whatever percentage is more than the amount, and so on. So that's why you have these natural brackets. Good. So as I said, I wanted to leave time for questions. Let me just quickly go through some notes and some contact information, and then I'll open it up. So here's a preview of the next MRMD, and this is getting more into the weeds of portfolio risk, and that's coming up this Wednesday. Making a few mistakes here. It's 9 a.m. I was confused. It'll be 9 a.m. on Wednesday. I will fix that before I send the slides out, but it was 9:30 today. What's Delta Vega? You may have seen it on the slides. That's my company. I'm a sole proprietor and I'm a consultant. I'm happy, as it says at the bottom, to explain what it's like to be a consultant in New York State, what the trade-off is of various different tax statuses, and whether you want to be a consultant or get a permanent position, or maybe something hybrid, like you get consulting, you get in the door, and then you hope to get hired permanently. This is a quick slide to show that London, a week from today, and most of Europe will be changing time as it goes from summer, the beach umbrella, to fall, the fall leaf. But the US is 1 week behind that. So there'll be a period where London and New York are separated by 4 hours, but it's only 1 week long. It's a lot worse in the spring. And then these are the last couple of slides. So here's the link, and here it does say properly 9 a.m. on Wednesdays for the regular ones. The second category is the live stream, which is also the archive on my YouTube channel on the Delta Vega. And the third is a link to the shared drive where, in let's say probably within the next hour, I'll put up these slides, the talk minutes, and any other useful things. I also put the slides as a LinkedIn post. And finally, here are my contact points. And I'm very proud that even though I am a baby boomer, and probably older, maybe twice as old as some of you, I was able to figure out how to put a QR code on this slide. And if you go to this QR code, it will ask you to make a contact request to me. Well, you're able to make a contact request to me then on LinkedIn. All right, so I'm going to stop the share and I can, yeah, you guys can unmute yourselves. I didn't do a group unmute. Um, and I'll take questions or chat or ask me to speak about something else. We can also go back to the deck if you have specific questions.
Jonathan, so I would like to start with apologizing that I knew about the session and then still couldn't join because there was a power cut at my place.
Right, right.
So I was eagerly waiting for the session, but then there was a power cut and I could not
No
join.
worries.
I was trying to join it. But the
No worries. Have you heard, Pratik, that Cuba, which is, so close to the US, it's, you can float in a boat from Cuba to Florida, but Cuba's had now a whole series of power cuts. So I mean, it's days people have no food, they have no whatever. It's horrible. It's like a natural disaster. They do not have a lot of infrastructure. We make a lot of jokes like infrastructure week and stuff like that. I think you've seen that in the US politics, but Cuba has they have 1950s. They are pre-industrial in some ways in terms of their infrastructure. So,
Right. So yeah. So but with that, like I do follow like your comments. I think on my post also and your post in general as well. And I think we have interacted a few times, right?
right,
And right. So the last part towards the last part, I was able to follow through and I could relate with some of the points because of like what I have covered in FRM and the work that I've done so far.
right.
And specifically, my doubt was related to how to deal with general wrong way risk. Because you also mentioned in one of my posts that, specific wrong way risk, it can be mitigated by hedging it, right? But it is often difficult to mitigate the general wrong way risk, right? So let's say if I know that there is some general wrong way risk coming out because of any factor, right? Which I can, let's say, forecast through forecast or like, through my intuition, let's say. I know, but then how do I take the corrective measures for that?
So that in fact has been modeled, and that was described in the counterparty risk. We talk about modeling both specific and wrong way risk. It's in the literature. Um, Hull worked on one aspect of that, and Glasserman and a collaborator on the other one. If I have it right, I know what they did. I think that Hull is basically modeling the wrong way risk as again a hazard type of process, but putting in the characteristics of correlation that you can then do with that. So I would look at the Hull model certainly. Glasserman didn't build a model per se, but they did. But they have a way of, for example, for a given volatility, you can set limits on how much wrong way risk there is. Uh, and that could be, and that's a multiplier. It's a little bit scary. Compared to the current risk, it could be, I believe, I don't have the charts in my 8 to 10 times more than the risk that you're doing now. But again, this is kind of a worst case calculation. So I would certainly look at those two papers. The references should be in that deck. And yeah, and I don't have the number of that. I think it was number 17. But on the public MRMD site, which is referenced in the Dropbox, you can easily see which one is the one on counterparty credit risk. So that's where I would start.
Okay, sure. So I'll just go back and try to find the answer to this.
Yeah.
So for now, like I had only this one, right? But I will certainly try to ask more questions from next session onwards and try to be more regular, especially
Right.
on the weekends.
Sure, that's fine. And if you ever want me to look at something ahead of time before you post it, I'd also be happy to, make a few notes. Um, that's fine. Like I did already say something about the Garson EWMA are very important models, but
Uh,
you don't want to impose them. But I think of them mostly imposed when there's heteroscedasticity. And the example that I gave in the talk when I mentioned EWMA, it's covered more fully in the textbook, is a situation where Morgan Stanley was simply calculating historical VAR, but unusual for them. So, obviously they're a top 10 Wall Street bank, but the other nine or so, the Deutsches, the Goldmans and things, only look back a year or a year or two. So I arrived to Morgan Stanley in 2011 and they were very worried because you see they had a 4-year look back. and they were about to enter a period in 2012 when they would be right in the middle of the financial crisis. So therefore,
Right.
they would be including in their historical sample periods that they felt were, not the current business cycle at all. Uh, Therefore, they thought that Basel and the Fed and so on would be penalizing them to put a lot of excess capital because just of that period. So essentially, what they did simply is they said, well, variance was a lot higher then than it is now. It's easier to model variance than standard deviation, but so variance is modeled in an EW. They modeled it in an EWA model. So essentially, if a P&L, let's say if a loss in the 2008 period had 10 times the variance, well, maybe we do it 100 times the variance, so 10 times the square standard deviation, then
Right.
you would scale down that probability in your calculation. That's what EWA does. The parameter in there is how far that these volatility or variances are calculated, what kind of a relaxation time they have, right? Like in physics, like are you looking back? Are essentially smoothing the variance over a certain number of days, or is it months or years and stuff like that? So, but that's the problem with EWA and GARTs, that you have to introduce new parameters. So you have to know what the relaxation time is, what like the that is a lambda as well, and has similar properties to what we talked about here for credit events, but there's no way to calculate lambda. And I'm a relatively new model tester then in 2012. 2011 is when the model test standards came out from the Fed, after all. And I asked the middle office, well, how are you going to calculate lambda? And they said, we're going to use 0.99. So essentially a very small effect of today is from yesterday's volatility variance. I said, why 0.99? And they said, oh, because Goldman Sachs uses it. So
Yeah, even I have read about it, like, it's like a constant. What I have seen in textbook is 0.97, right?
it's
Sometimes they change the value, but it's mostly like 0.97 or like somewhere between that
it's
value, only around that value.
it's like licking your finger and trying to figure out how so there is no way to calculate it, and that's the problem that Garch has two parameters. Garch 1.1 has two parameters, and then as you increase the complexity of the Garch model, that increases. Um,
Right.
But there's an approach, and we talk about that in the book, that the approach that they really proposed was looking for successive, essentially looking at the back-tested results in the case of VAR. So which is the one that has the fewest breaks? And that's the one they ended up with. But then they got more into it. And again, this is in the VAR MRMD. It's not just the breaks, but it's also the distribution of the breaks. It's the independence of the break, and so on and so forth. So we did back then is we stepped lambda from 0.95 to 0.97 in steps of 0.01. And we saw which one had the best statistical properties of those residuals. Essentially, this is which is the one that you've removed the center skedasticity enough so that you have an IID distribution and you're properly calculating backtesting. But in general, it can't be done. And
But then that would keep on changing with the like,
right,
so if you're calibrating it
exactly,
within for a particular time period, right? So for example,
exactly.
right, it would
So
change.
not just that. Then the question is, you know, if so, and they tried to do this on not on actual P&L series, but on the S&P, on things that you could easily get. You don't buy and sell the S&P every day. You buy and hold it. But they did the thought experiment of, let's say, the return from the S&P using that in the back test. That's a pretty easy thing. Any first year finance student can do that. But you're right. It's going to be different at different times, even in the case of the S&P. And then the other complication is that banks don't only sell one thing. They're not just selling red shoes, right? They're selling blue shoes,
Right.
green shoes. So maybe the green shoes should have a different lambda. Maybe they
Oh
should
yeah,
have, right?
that's another thing,
Or a
right?
different asset class. And then how often are you going to recalibrate and stuff like this? So
That's true.
we went through
Ideally,
all of that.
it would
Yeah.
even be different for different instruments also to that scale also because they would be traded. For example, exotics would not be traded that frequently,
Right,
right?
right. Yeah, so you
So
have liquidity so that
yeah,
and now that I've become sort of this evangelist or whatever, imam, rabbi of observational error, not having large enough sample sizes, what you just described let's say the empirical lambda that you obtain from a low liquid asset is probably going to have a much larger observational, standard error. So therefore,
Right.
you have to factor that in. At the end of the day, you could, yeah, yeah. I don't know what else to say on that. I think the most important thing is just to recognize that heteroscedasticity is out there, and indeed, history did
Right.
repeat itself. When I was at my last post at Jefferies, there was a model that backtesting was breaking in VAR. So I said,
Right.
well, let's look at the data, right? That's the first thing. So it
Hmm.
was in particular breaking with European data, but not with US data. So I said, oh, that's interesting. So it's breaking on Euribor, but it's not breaking on LIBOR. So what happened in Europe that, it wasn't the negative rates issue. I mean, that distinguishes the US and
Yeah,
UK.
typically that is the first thing that comes to
Right.
mind.
And I always tell my friends, I think you have the same impression as well. If you add together the four largest European economies, you're essentially the size of the US economy, in GDP. So it's very similar. It's very similar physics. Uh, and so then I looked at Euribor, and I looked at Euribor recently, and in 2000 it was like, in 2020 it was like this, 2021 it was like this, and then it went and got very heteroscedastic. And I
Uh,
looked at that and I said, gee, there must be something that I can learn from this. It was the invasion of Kiev, the invasion of Ukraine, that
uh,
sent European rates crazy. And so therefore, if you're trying to do something that uses both time periods, like the 4-year look back for Morgan Stanley into great financial crisis, you have to have a Garch or something like that so that you
right.
can remove the heteroscedasticity. And while we never did that at Jeffries, I certainly pushed for a lot of meetings about it. And I got a lot of pushback. We can't change anything, stuff like that. And I said, well, we know what happens if you do nothing. If you do nothing, your model is going to fail back test. And as I described in a previous MRMD, that means that the regulators may require you to carry excess capital. But your model is fine. It's the data that's wrong. So why don't you fix the data and then you won't, that Basel system, I don't know if you're familiar with traffic light system that.
Yes, yes, yes. There are like, there are three zones, and then based on
Right.
that, a multiplier is applied.
Yeah, it's typically 99% VAR. So you expect on 250 trading days that you expect 2 or 3 exceedances. And that's the green zone. I believe it goes up to maybe 4 exceedances or 5. Then there's the yellow zone. And then if it's more than 10 exceedances, then you're in the red zone. And
But
what happens when you're in those zones is you get, and this is, of course, the way regulators think, not the way mathematicians think, they give you a multiplier. So you might have to put up twice as much capital as for the green case if you're in the red zone, or at least like, I don't have the
I
numbers in
think it's
front.
even more. I think 2.4 is the
Yeah,
exact value or something.
right. I mean,
Yeah,
those are made up values because if the model isn't
exactly.
working right, then you really don't have a good description of the data. You're describing, the economy of Singapore when you're trying to describe the economy of the United States. I mean, it's not going to work. But yeah, but that's
But
fine.
I think
I've liked our dialogue. I think I still see someone's on YouTube, so but we can also maybe just do some one-on-one things and things from time to that. I'm very used to, especially from my time. Well, I mean, I was at Goldman when in '03 when it first opened Indian offices when the US. So I know and I experienced even at the beginning, just like I was at the dawn of the credit default swap era in 2000, which was when the most important thing was that the JP Morgan corporate bond desk that I was working on, the Chase JP Morgan, merged with the JP Morgan credit default swap desk. So that was, I mean, it's good when you see something from the beginning. Jeffries and many of the firms like PwC do employ excellent financial engineers in India. So I'm used to, doing the time zone thing. And I know I may be keeping you
that's
from your
great. I
dinner.
think you have been doing a really noble thing, like sharing all of this immense knowledge just for free and like with your experience. It's really incredible, like and how you're able to manage with it. I'm really grateful. Like so that's why like I was initially asking like like why are you doing this? Like you're doing this for free, of course. And it was really amazing because I've never seen anyone with such an experience, like giving so much of time
Thank you. Thank
just for
you.
sharing knowledge. So really,
I
really just
appreciate that. I think it's just like the old corporate finance thing that, you're investing now for the future, that you expect that this is if you do the present value correct, that this is a profitable investment. the two things that come out of it is maybe as dividends are one, for the textbook, they'd like us to create teaching materials. In fact, they're giving us a small grant to do that, to accompany it. So that would help faculty members to teach it or people who want to do self-study. Of course, I have big plans for the book in general. I'd like every country that does finance in English or substantially does financial engineering in English to buy a copy of the book and to teach a course related to model risk. So that would be a great thing. And so that would definitely include India. But the and then maybe translated, I don't know. But it does help, and there have been things that we've worked out on this and different ways of so I would say I learned by teaching. I mean, frankly, I looked at things like Udemy and Coursera. Coursera, I just couldn't figure out their in for it. But Udemy, I might get like maybe $50 a student for giving this. So this is not really a way to make money. If I wanted to make money, and I am thinking about that actually, in the case of a PwC, let's say that you're about to send a whole bunch of your junior people over to a Jefferies or to a JP Morgan, or to start working with a team in New York or London. Maybe there should be a training that those students go through so they get the estimates, and maybe they should buy my book. And so I reached out to Deloitte because I know a guy there, no response, and to KPMG, I know quite a few people there. And Himal dropped off the call, but he's EY Mumbai, so he also might be, but we're all junior people, and I don't know. I think training, maybe you'd make a little bit more. I think people regard those people as vendors. It's executive training, maybe, that you could do something like this. But I'm doing something primarily to junior people. And it was the folks from East Asia, South Asia, the people who are somewhat less experienced in US markets at Jefferies that motivated me to do this. And my co-authors as well. They've seen, and we've trained a lot of people. If this book saves me time in my next Wall Street job of training young students, and if it gets them to get insights, then that will also have been a, net present value positive investment.
That's great. Like, you never know, like how these dots may connect with, whatever lies there next in the future. But yeah,
Right.
you raised a very valid point because at least what I've observed is like in the last few years, 4 or 5 years, risk management in particular has grown exponentially within India. Like when
Right.
I joined back just 4 years ago, my team was like a team of 20-25 members maximum.
Sure.
Right now we are around 60 or 70 people, and we are planning to hire 40 people more, right?
Yeah, that's great.
And
Yeah.
so we always need people, always a challenge to train them like at the same
Yeah.
pace at which the regulations are changing,
Right.
right? And
Well,
risk management.
it's also the pyramid thing, which is sometimes talked about with LIBOR in a different context, but it's, I've worked at Deloitte and I've managed PwC, KPMG, any and Y people. And so I know that the idea is if you're the senior manager or let alone the partner or principal, you cannot bill all your time at the client or you'll quickly run out of budget, right? So therefore,
Right.
the incentive then is to put the most junior people in there. But, the kind of conversations I've had with people as an independent consultant was, we had a big four firm in here and we paid them a lot and we're paying you less and you're doing a lot more. So it also creates the opportunity for independent consultants to come in but I think a rising tide lifts all boats. I think if there were training and I have, by the way, I have done trainings to consultants. Like I worked, one thing I did, which was not a bank, was I worked for Numerics for 2 years or so. And so part of that was I started off in sort of quant sales and then went into financial engineering. But I trained through there, like the World Bank. Like I did a one-day trip to DC. I think Boston and DC can be done either as a day trip from New York or just a simple overnight. And so so I trained a whole room of World Bank people, Canadian Wheat Board as well. Those are institutions that don't have the quants, but they end up getting into complicated structured deals. Some Deutsche or JP Morgan is involved as creating a structured product for an investor in Japan, let's say, so that the investor in Japan wants a structured coupon, and the World Bank realizes that if they participate in this, that they could receive the other leg, which is LIBOR minus, or whatever it's called these days. So then they can give that to so that's in ways how they World Bank funds companies with less than perfect economies. And in the same way, there are a number of farm boards, there may be in India as well, that also strive to get sub-LIBOR financing or low-cost financing so that their farmers can, grow the rice and flour that make great things like naan and here pizza, right? So
So that's really great. So I think we should continue these conversations. It was really I really like this. It was great experience, like having
yeah,
this
let's do it ad
conversation.
hoc. And another thing I'd be curious about is, I do have this Delta Vega website, but I don't use that. I'm using Zoom and it seemed and for paid Zoom at even the lowest level that I could do the YouTube live stream. But there's no reason that I couldn't host this on my website and just, not and I could stream everything there. I don't have to have things in 10 places like Dropbox and this and that. So I'm paying, monthly for the website. Partly it's to have a corporate email, and the FTP site that we're putting, like Python code and problems for this. But the publisher has a website. I mean, anyway, the point is I'm underusing deltavega.com. And if you look at it now, it probably says, I'm going to help you solve the LIBOR, transition. And so it's updated. It's like, looking at an old TV show from the 1970s or something.
Okay, okay, okay. I will do visit that, right? And if I have any suggestions, like I will share these
Right.
with you certainly. Right.
Yeah, that's a lot harder to modify. Like that, I had to get people to put up and I had to, edit HTML and stuff. It's pretty seamless. I mean, you can really do your own show. Another area that I've thought about doing is possibly a podcast where I've heard that, 45 minutes, at least in the US, seems to be about optimal. But, but a lot of the stuff I do is visual. So whereas the way that I consume most podcasts, like Freakonomics and things about US politics, and by the way, some very smart, like I think his name is Shankar Vijantan, has one called The Hidden Brain. So he's an Indian American who's absolutely brilliant when talking about, he even interviewed Daniel Kahneman on behavioral economics and, what parts of the brain make it so that the climate crisis is something which Kahneman said, people will never take seriously because of the way of human experience. So Vedantan, if that's this guy Shankar, okay, has a weekly podcast on that. That's just brilliant for my drives to Long Island and around the city. I'd much rather have that than a bad radio station playing rock and roll. You
I
really
think you
learn a
can
lot.
even run like your own podcast on your own YouTube channel also,
Right,
right?
right.
By taking up one topic each, right? And from that you can set up a list of questions, right?
I have the
Uh,
YouTube channel. Yeah, it's just the YouTube channel is not something that people will go around and say, "Hey, I just looked at this on a YouTube channel." At least maybe not in the US, whereas they can say, "Oh, yeah, I have a podcast with Jonathan Schachter talking about this." Right?
So I think so these days I think like it's more I would say a slightly Gen Z vibe or like those teenager things like putting up shorts or maybe some different kind of videos that okay our text is coming to make it more engaging, right? So I think shorts could be something. So
Yeah.
maybe you may need to like expand your team, like may include one or two members specifically for video editing, like and
Right.
managing the
Right.
YouTube content, right?
No, that's
And I
fine.
think
Yeah. Or
uh,
my kids. I mean, my kids are in music, but they're doing
oh
things like
so
they're
if they
figuring
can
out.
get time, so I think they would love to do that.
Right. I mean, the microphone that I'm using, I think, is there, but we have a whole setup at home, and the older one wants to produce the younger one's compositions and put them on
Oh,
Spotify. The younger one, they're both in music. The younger one just started maybe the best American musical from the standpoint of rock and roll. So it's the School of Rock type of thing in Boston. And he's just brilliant. They're both brilliant. They tried before Josh started college this fall. Sam was trying to literally to drop an EP on Spotify. So he's got all this, and he's learning the sound physics and acoustic and all the. So you learn quite a bit. It's if you're an experimentalist, if you like to work with data as I do, that it's fun to do that. I mean, it took a long time to get many meetings with Zoom to get the Zoom to talk to YouTube, but we finally did it. So.
yeah, you can even do I think one more thing is like even from these Zoom sessions, you can take many clips and put on YouTube. Like that
Right.
is also something, that is also something you can do. But
Yeah.
yeah, overall, like it is really great. I think with this you can really build something big, like which expands more beyond just these sessions.
I think it needs to transition in some sense. One of the reasons I was doing this since the summer was because December 1st is the first hard deadline where we have to give intellectual property to the publisher. And that's what, 6 weeks away. So at that point, I sort of feel like it would not be a good idea for me to talk about the book, but I could talk about things and not mention the book, just because I don't want to make it look like we are front running or whatever the publisher. So the material is to a certain extent going to be locked down after that. Now it's only a quarter of the book. So, since they haven't seen the entire book, what is a quarter of the book? What is a quarter? Here, I'm giving you a quarter of what I have in the bank account, but I'm not going to tell you what I have in well, I mean, you could take 4 times that. That's a bad example. But a quarter of, let's say, all the food that I have in the house, I'm giving to you, right? But you don't know how much food I have and what kinds of food. So I just have to give them a quarter, but then I have to do that periodically. So that is 4 buckets, so that by March 1st, they'll have the whole book in the tank, with the exception of things like Python code, problems, but the main so as that happens, I think, I have to go on and do some of these other topics. One clever thing I thought, I should wind this down, but is I'm up for a job, and this is Bank of New York, and they're looking at hiring me to do 2 things. It's to support the London FX traders, which is largely flow, but there's still, I think, a lot of model risk to be talked about, as far as, like knockout options and things like that. And with FX, I think I may have mentioned this to you, but I worked with FX options when I was at Numerics. We put specific
So, by
FX.
the way, sorry, I'm sorry to interrupt you, but you are still streaming on YouTube, so I think it's fine, right? I think it should be fine. Or do you want to stop the streaming and then have this conversation?
Have a more private conversation. But my point is that I think but that I'm not using this. I'm saying not just to market the book, but now to market my company and to market. So one of those slides does say, if you want to understand the differences between a corporate to corporate consultancy in the US, a 1099 and a W-2, the short answer is corporate to corporate is the best, because there's actually no salary involved if you're your own corporate. You just distribute money to yourself, so there's no payroll. Anytime there's payroll in the US, there are payroll taxes. And
Yeah.
if you're a 1099, then you're an independent contractor. But since that is a salary, the IRS is going to hit you up with 15% because you didn't pay any Social Security, because you're self-employed, so you're not paying payroll taxes again. With a W-2, eventually you could get some taxes back, but the payroll taxes go for sure. They withhold income tax though, whereas I don't have to withhold anything, because again, I'm not paying us out. The company's a pass-through vehicle that doesn't pay taxes. Only the employees get it, so that way you avoid the double taxation thing. That's an S corporation was created by the IRS for smaller businesses, so that they don't have to pay corporate taxes. But instead, the IRS taxes the money when it's paid. It taxes the individual who receives the money as salary.
Got it. Got it. But I think, yeah, being if you're operating your own firm, right? So then the effective taxation would always be less than as compared to the time when you are employed by a bank or something, right?
Well, if it's fully passed through, and that's largely what I've used it to, same as I do with an Airbnb as well, I basically spend all the assets, so I don't show a profit. Everything is distributed. I'm not going to say
Right.
paid because that sounds like salary.
Yeah.
But the Airbnb, I'm still fixing up. I got a couple of things, but that's been a pretty good business. Nowhere near a Wall Street salary, but being 62 and having a beach home and having that there, if I could start getting that passive income, that's certainly, you don't retire from being a landlord where you have to retire. So that could be something that plus Social Security, plus maybe a couple of lucky bets on the stock market, and then I would have a fairly comfortable retirement. So, but I'm not retiring, and my father worked till into his late 80s, so 25 more years or so.
Yeah. Plus, I think once you enter into these independent professions like, a lawyer, doctor, or a teacher, right? Like teaching instructor. So I think then you also enjoy this process also, right? Because you have accumulated all this knowledge that you want to
Right,
pass
that's
on to
right.
someone. Yes, if there is
Exactly.
a way to monetize it, and there are ways, like, because people do value your experience in all these domains, right? So you become more expensive and like
Right.
or you would say more valuable, right? So with experience, so
No,
I
that's
would say,
right. And that's more like a big four firm. Like with Deloitte, we did a whole big thing at Las Vegas where we did a fake, making a proposal to a fake company and think, just for so that I think that the Deloittes and PwCs of the world are selling their expertise, their intelligence, where the Wall Street firms and the City of London firms are selling, maybe something tricky I mean, cleverness for sure, but it's not as much, you don't say, I know this really smart guy. You say, I know this guy who created this toxic waste and now he has something on the Isle of Wight or something on, the Hamptons or whatever, but whereas, uh, and that's also why you get a lot of ex-regulators in the US, like they leave the Fed and then they go to a consulting company. I'm still happy with the idea of working back for a big four firm at some point, but anyway.
yeah, I think
All right.
there are more than certainly more than one ways for you to work
Right.
for like big for any other bank, like
Yeah, but let's figure it out. Let's set up maybe ad hoc, and I'll try to set up the next meeting, just you and I, just as a call or short Zoom. I do want to apologize though for saying that you lived in Mumbai, because I know at least in this country, our major cities, you don't want to screw things up, right? Like we have a incredible sports rivalry with Boston, which is Washington's actually closer to New York than Boston is, but Boston historically, those are essentially we feel they're the most important cities on the East Coast. Well, we feel like Boston's the intellectual capital. The U.S. is the government, D.C. is the government capital, so that leaves everything else to New York, the arts, business, publishing. So, and I think most people from abroad would say New York's the capital in the same way that, so I don't want to get into Mumbai versus Delhi, but if there's a similar thing,
it's
um,
true. Like, you will find most of the popular banks, like, in Mumbai only.
right,
So
right,
it's literally the financial capital, right? Plus,
yeah,
you have the Bollywood over there, right?
right.
So,
Oh, is that right? I didn't know where Bollywood was, so yeah, yeah.
yeah, it's based out of Mumbai, right? So, right. So, yeah, it's I would say, so my first job was based in Mumbai only. It was at JP Morgan. So it was a short stint of 6 months only. But yeah, so it's really a nice place.
Yeah, no,
Uh,
that's fine. And in fact, movie studios started in my neighborhood in a couple of neighborhoods over in Brooklyn in like the 1910s and 1920s. And then suddenly they all decided to move to LA. So, but New York still has all the TV, it has all the radio, it has, Sony Entertainment. So most of the largest US music competes with a Dutch firm. But yeah, it's, my grandmother would say, why do I have to go anywhere else? I got everything I want in New York. So,
yeah, that's true. Like it's people's dream too. I think most of the people, anyone who would be working in finance would want to
right.
like settle to New York, like eventually.
And if you do real estate, for instance, there's the US real estate market, but then there's the pockets of it. And Manhattan has its own special analysis.
So you live in the core of New York, right?
No, I commute to there. I've always been a little bit outside. So I can get into downtown Manhattan by train in 30, 40 minutes and to Midtown in about an hour. But it's just one train, and the train itself is a 5 or 10 minute walk. And I grew up on the subways. So in fact, I wrote a good bit of this talk getting together with a young lady for a drink, both directions. I was just right. I can write on the train. I view the train as sort of my living room, like a lot of New Yorkers that you just sit back and read, or unfortunately, some people talk on the phone, but well, I won't go there. But that,
Yeah, yeah, the commute system is really great over there. Like because a lot of the people who move from India to New York, so their offices are based out of New York, but they stay in New Jersey because, like
right
the
path.
rents are expensive there, and then it's very rushy over there,
Right,
right?
right.
Like
No, that's right.
so,
That's the city. So the other thing to do is to go to Brooklyn or Queens. I live in Brooklyn, but I also like the idea of having a home and not some faceless apartment building.
Yeah.
But yeah, I mean, for me, and I have a car. I mean, you can't have a car really in Manhattan, or if you do, then you're paying not to use it essentially.
Oh, yeah, exactly. That's true.
But
So,
I have a driveway. I have and I can walk. I have most of the benefits of New York, but I don't have, I can't walk to Lincoln Center. I can't walk to Carnegie Hall, but I can bike there.
that's
Great.
great.
Okay, so let's touch base. Let me put something on the calendar, at least sometime the next week. We have going up to Boston to see the young kid, the end of the very exciting finish of the U.S. baseball season, which may involve a crosstown championship, so-called Subway Series between Queens and the Bronx. So that could be fun. But we'll see. The Bronx team, my team is in it. The Queens team, they have to beat LA a couple times, so we'll see. But it's either going to be New York, LA, or New York. New York versus New York. So it should be a great series. Good.
Perfect.
Okay, so have a good evening. Hopefully I didn't take you away from your sleepy
No,
dinner, but
no,
yeah.
no, that's fine. Like it's not very late. It's just 9 p.m., right? So I'll
Right.
just go have some pizza. Right.
Right. Well, you're right. Your supposition was right, though. We got substantially, I think, more people than I would get just on a midweek morning, or
Yeah.
evening in the case of
Actually, I
Mumbai.
invited those last two people, and then
Yeah.
I was trying to, I could like invite more people, but since there was a power cut, I could not invite them earlier, right? Plus, I didn't want to spam it into any random group. I didn't want to invite
Right.
any a lot of people who are not relevant to this, because then
No,
I've
that's
seen
fine.
some. Yeah.
I mean, if I look at the YouTube statistics, like 53 people have viewed my channel over time, it seems like the value here may be in the archive, and so therefore that the Udemy teaching, something that's not necessarily in real time, but that can be viewed when
Exactly. Later when it grows, right?
on your lunch tomorrow when I'm asleep. Yeah, so something like that.
I will share the link in my group though, so that they can watch the recording, right?
Yeah, you can. I mean, I'll put the whole deck up, so you can just take that down from LinkedIn, or I can send you it as a message if you don't see that. I think you'll see it. I'll put the deck up, and then the website also has the minutes and us talking. Uh, so we should cut it. But
Perfect.
all right, enjoy. Thanks very much. It's good to see you in person. Yeah.
Thanks a lot, Jonathan.